morning, everyone. My name is Don Daniel, founder of P.I.L.L Method International. And today, it is Sunday, November 5th, and we've got a hot show today. We are giving away our money to the bank unnecessarily in the form of interest, paying 75% more interest than you need to pay. We need to stop it, and we learn how to do it right here. If you have any questions about any type of debt, anything that has to do with money, come to the stage here in Clubhouse right now. I invite everybody up to the stage right now, even if you don't have a question. Come on up to the stage and at least sit here. And if you do that, guess what? It encourages other people to come into the room. So share the room, come to the stage, raise your hand. All you have to do is raise your hand. We bring you up and you don't even have to say anything. If you want to come in here and learn, just do that. Can I encourage one or two people to do that right now? Can I get one or two people to raise your hand, come to the stage, and just hang out for a bit? Can we do that? No? All right. Well, listen, you may be inspired to do it a little bit later. All right. Listen, again, my name is Don Daniel, founder of P.I.L.L Method International. P.I.L.L stands for prepayment of principal, isolating the principal amount, leverage, and liquidity. We're going to be going over some numbers to prove once and for all that residential home buyers and real estate investors are giving away money unnecessarily. Stop it and use that money to pay on your mortgage to save interest cost. And if you so choose, you can pay that house off or that commercial building in 7 to 9 years. Or if you don't want to pay it off, you can increase your equity 5 to 7 times faster and cash out refi 10 to 15 years sooner at a much lower interest cost. Listen, folks, if you're a real estate investor, just think about this. The property is getting more, it's gaining in value, all right? Your property is gaining in value, and you have rents coming in that's helping you to increase equity. Why not put yourself in a position so you don't have to wait 10, 15 years to cash out, to use that cash, to reuse that cash, to develop, to buy more property? Cash out a lot sooner. Stop giving away all your money in interest. Can I show you a couple of things right now? I just need to show you a couple of things. Can I show you a couple of things on how a real estate investor, how much money real estate investors are giving away? Can I show you? Huh? Can I show you? Can I get a number 9 in the chat if you want to see how much interest real estate investors are giving away, how much homeowners are giving away, and how to stop it? All right. If you want to see that, put a number 9 in the chat. If you're online with me here on YouTube, Facebook, Twitter, and LinkedIn, go ahead, put something in the chat. I'll show you how much we're paying and how you don't have to pay that money and how you can use it to help yourself. Oh my goodness, I see some number 9s. All right, so you want to go to that link there that we have on, that link will take you to YouTube. And if it would be best if you do it on a separate device, and then you can see the numbers. I've got a $350,000 mortgage in my amortization schedule right now. So we're going to add that to the screen. All right. And let me change this over. All right. Change this over to here. There we are. So we have, and add this to the screen. There we go. So we have $350,000 at 8%. That's what the interest rate is now, 8%. Now I need you to also invite some other people in as well. Okay. So the payment is $2,568.18. If you are a real estate investor and you're renting this property out, let's say it's a multifamily, and you're renting this property out, and listen, you're cash flowing $1,000 to $1,500. That's pretty doggone good. All right. But I need to show you out of the rents that you're receiving, $234.85 goes to principal. You've got $2,333 going to interest. Out of that payment that your tenants are giving you, after you take your part off the top and you pay the mortgage part, okay? And listen, can I stop right here for just a second? Do you know how many real estate investors have told me, Don, I don't care what happens after I take my $1,500 or $2,000 off the top. I don't care. I don't care. The tenants are paying the mortgage. The tenants are paying the mortgage. Why should I care? And that couldn't be farther from the truth. Your tenants are not paying. If you're a real estate investor, your tenants are not paying your mortgage. They're not. Your tenants did not contract with your bank to pay a mortgage. They contracted to do business with you. They signed a lease to pay rent. Now you take that money and now you go and pay the mortgage. Just like when your tenants give you money, they don't buy air conditioning. They don't buy water heaters. They're not buying that. You are. So you set up so that when you get your money, you want to make sure that you can conserve as much of that money as possible. You need to start looking at what we call interest consumption. How much interest are you consuming each and every month? All right. How much interest is being spent out of your money? You know, when it comes to taxes, when you get your $1,500 to $2,000 off the top, you're trying as hard as you can to keep as much of it as you can and get your when you do your taxes, you're saying, listen, what deductions can I get? What deductions do I have so I can preserve the amount of money that I'm getting? Do you realize, ladies and gentlemen, that because of all the tax deductions there are, you're going to pay far more interest than you'll ever pay in taxes. And no one is talking about how you can cut your interest cost, how you can cut your interest consumption. In the first year, on this $350,000 mortgage, you pay the loan down by $2,900, but you pay out of the money that your tenants gave you $27,894.34. If we were to add that up, that would be $27,894.34 plus what went to principal pay down. All right. Let me see here. I got the numbers in here wrong. I've got, let's see, $27,894.34 plus $2,923.82. When you add it together, this is how much money your tenants gave you in 1 year. Now you took your money off the top, okay? But they also gave you this money, $30,818.16. What do you have to show for it at the end of the year? Yeah, I got to pay my mortgage down by $2,900 out of $30,000. Now, can anybody explain to me why people think that that's a bargain? Why do you think that that's okay to give away that kind of money? All right. Listen, if you want to come to the stage, please come to the stage and go ahead and raise your hand. Come on up and ask any question you like. Let's get the conversation going today. So now, if we just do the math on just the first interest payment of $2,333, okay? Our interest, let me move this up so you guys can see. $2,333.33. And we divide it by our total mortgage payment. Our total mortgage payment is $2568.18. That's 91% of your payment going to interest. 91% of the money that your tenants gave you went to pay the mortgage, went to interest alone, and you don't have to do that. You don't have to do that. Let me show you how easy it is to preserve that money. Okay? How easy it is to preserve that money. For as little as $236.41. For as little as $236.41, you can save a ton of money. Let's just say you made your very first mortgage payment, and you can take a look and see your next principal payment the next month. If you prepay this to the bank, if you give it to the bank early, you choose how you want to pay your money back. You choose it. When you choose it to pay this money early, you're paid down to here in the first month, and your next mortgage payment is on line 3 of this schedule. You just saved yourself $2,331.77 in interest you don't have to pay. With as little as $236.41 invested in your mortgage, you get a response. You get a return on your investment of $2,331.77. Good morning, Horace Jennings from Virginia. Good morning to you. Horace is here watching us on YouTube. All right. So where are you all from here in Clubhouse, and anybody else is watching us on YouTube? I want to make sure that we are abundantly clear that since 1936, residential home buyers and real estate investors who use bank money have been set up in a system where they pay far too much money in interest. These loans should be paid off in 7 to 10 years on average, but they set them up for 20 and 30 years so that the investors can make money that long. It's set up for investors who buy your mortgage. It's not set up for you. It never has been set up for you. If you're using credit cards, if you're using the money to borrow money for auto loans, if you're using money for your mortgages, if you're borrowing money for even student loans, okay? You can borrow money at a discount. If you are an investor, you know that you make your money when you purchase. You want to purchase below retail so that no matter what happens, you can always sell the property and make money, correct? Well, if we're paying so much attention, to how we buy the property, why don't we pay at least the same amount of attention to how much we're paying for the money we're using? No one is teaching how to borrow money at a discount. If you have any questions, come on up to the stage, even if you just want to sit on the stage. Listen, this is a conversation. If you're in Clubhouse, this is a conversation that we need to have. Stop giving away that money to the bank. It's called interest consumption. 35 to 39% of your take home pay is going to the bank, and it needs to stop. All right, Mr. Dwayne, come on up. How are you doing, sir?
God bless you. Doing well, man. Good morning.
Good
Thank
morning.
you so
Good
much.
morning. So, do you have a question or a comment?
No, I just wanted to say that as a mortgage loan officer, a lot of this stuff is not discussed, and it is decimating our people. So I really appreciate the fact that you are sharing it. I'm not great with the numbers. I'm a lot better than I used to be. And as I listened to, I think he did something like this a while back. I don't know. This is a replay. I'm sure this is on replay, but I know that we never look at the interest payment. And I was just hoping that you could delve further into the issue of, well, let me say it this way. We're looking at properties out of state right now. We just purchased a house for $20,000 in cash, a single family home with land. And so now a lot of my friends are interested in moving in this particular area and acquiring more property. And I was wondering if you could help me to structure on how to best do that relative to taking out a mortgage on the property, a second mortgage, or just keeping it free and clear, keeping it free and clear, and getting maybe a HELOC or something like that. But I really appreciate
Sure,
the time.
Dwayne. Listen, as far as you know, you say you are a mortgage lender.
Loan officer, loan originator.
Okay,
Yeah,
you're
license.
MLO.
Hmm.
Oh, all right. What are you hearing from people in terms of these interest rates? What are you hearing?
Well, most people are saying, "Hey, man, they're going to 7 to 8%. It's really high, so a lot of people don't want to move. So it's been slow." In
Okay.
certain respects. Hmm.
Listen, if they come to you, if they're asking you questions, that's a good thing. All right. I
Yes,
have
sir.
on my screen. Are you? Can you see my screen right now on YouTube? Do you have it up? If you're talking, we can't hear you. You're muted.
Yes,
Okay.
sir.
So, are you on the same device or a different device for
Yeah, that's
YouTube?
the problem. I'm on the same
Oh,
device.
can you go to because I'd like to have a discussion with you on how you can develop more business out of these higher interest rates. Is there a way you can see YouTube on a tablet or a laptop or something?
Shoot, give me. You have to give me a minute.
Okay,
Sorry.
go right ahead, man. Just go ahead and take your time and do that. Anybody else that wants to come to the stage, please do, because we're going to help Dwayne make more money from doing loans at a higher interest rate, ladies and gentlemen. In fact, these higher interest rates can actually save you more money if you can afford the payment. What do you say? So I need more people to come to the stage. Dwayne came up. Oh, and I see some party hats in here. So congratulations to you for being on in Clubhouse for the very first week. All right. Congratulations. And thank you for coming to this room. All right. So while you're going ahead and getting set up, Dwayne, why don't you go ahead and mute your mic? When you're ready, jump back in there. Okay.
Thank you so much.
All right. So listen, folks, we're going to be talking about the family, the average family, and these are families that do well financially. All right. We're not talking about people who are in financial trouble. We're talking about people who do well financially. Even the average family that is doing well pays 35 to 39% of their take home pay just in interest payments alone, not the total loan payment, just the interest portion. Okay, add it up. How much of your money is being consumed in interest? It will scare you when you add it up. Okay, even though you're living well and you can do whatever you want to do. Okay, the average family has 13 different debts. That's the average. So that means half the people have more than 13 debts. Okay, Half the people have more than 13 different debts. So listen, that's the kind of society we live in. We're expected to borrow money, to leverage that money so that we can do things now instead of later. And if you do it right, it's okay. If you do it right, it's okay. So here's what we need to know. If I could borrow money at 75% off, where I'm not paying all of that interest to the bank, isn't that money you could do something else with? Come on, everybody. Isn't that money you could do something else with? While Mr. Dwayne is getting set up here, and if you want to see what I'm doing, all right, let me see. Do I have another hand up? I do. All right. Come on up, young lady with the party hat. Okay, I'm trying to bring you up. I'm inviting you to speak. Okay, great. All right, you're going to have to pronounce your name for me.
Hello,
Hello.
I just joined. So, um, my name is Amaka Chiamaka, and
Okay. And you're from where?
I'm calling in from Dallas.
All right, from Dallas. Listen, I want to thank you for being here. And listen, feel free to ask any question that you'd like today. All right. Do you have a question for me, or did you just want to learn from the stage?
Thank you, sir. I appreciate you.
All right. Listen, whenever you want to, just jump in there and ask your question. Okay. Let me bring Miss Leslie up as well. Miss Leslie, how are you doing this morning? Hit that microphone in the lower right hand corner. There you go.
Good morning. My name is Leslie Jennings. I'm calling from Anchorage, Alaska. I've been a real estate agent here for about 9 years. I came to the stage because I really want to be able to educate the people that I have put into homes so far. And then also, the market is going crazy. Well, gone crazy. So I want to be able to educate people who still want to buy, but the interest rate has scared them off, kind of pushed them out of the market. So I'm
Okay.
here to learn pretty much.
Okay. Well, listen, here's what we're doing, and you can take notes on this. What I am using here on my screen is an amortization schedule that was put together, a calculator by a guy named Brett Whistle, Bretwhissel. This is not my program. I just use this for teaching purposes. And Miss Leslie, if your clients can afford the payment, we can show them how an 8% interest rate can actually work to their benefit. How would you like to see that?
I would love that. I would love to see that. How do I get to your YouTube page?
Okay, let me get the. I'm going to copy, and here is the link in the chat. All right, you go to the chat. There it is. Or you can go to YouTube on a separate device, on another phone, a tablet, or your computer, and search for Pill Method in YouTube, and it'll come up, and you'll see our live broadcast. All right, and you will be able to see the numbers. And if you can't do that right now, the numbers will be there for you in the replay. All right, so we're bringing somebody else up to the stage. Come on up. Come on up, sir. There you go. All right, sir. How do you pronounce your name?
Yeah, how you guys doing? My name is Ben. The
How,
other name Babu, it's in Swahili means grandpa. So I've been a grandpa for 2 years. So that's why I say Babu Ben B. Otherwise, just call me Ben.
all right, Ben. How are you doing?
Not too bad. Thank you for to bring me to the stage. I just have a question, if you can allow me to ask.
Go ahead and ask that question, sir.
Okay. I'm just a new homeowner, planning to buy another home. So the home I have right now, I have a 16 by 80 feet garage, which I'm renting it right now. and the garage does pay my mortgage. But I would like to know how I can benefit from me paying my own mortgage and use the people who are renting my garage to pay the principal. So I do not understand that. Is it okay for me to take the whole money from the garage and put it towards my principal? Is that beneficial to me, or should I wait? The other question is that should I do it monthly, or should I wait until the end of the year to do so? Because I think if I put it in as an income, end of the year, I have to pay tax on it. So that's all. I don't know if that makes sense or not.
Listen, you're making perfect sense. You're making perfect sense. So you want to be able to see these numbers. I put a link in so that people can see what the numbers on the screen on YouTube. And when you get to YouTube, please go ahead and subscribe to our YouTube channel so that you can see these numbers. All right, go to YouTube and let's see. Horace Jennings wants to come to the stage. Go to YouTube, search for Pill Method, and then you will be able to click on our live. And right now, I have a $350,000 mortgage at 8%, and I want to show you what can happen when you choose to save money this way. All right. So Leslie, Dwayne, are you able to see my screen right now?
Yes, I see it.
All right, great. So Leslie, would you mind working with me?
Not at all. Don't ask me any math though.
No. This is all about pictures because I'm not a strong math person. You know, I have what's called autism spectrum disorder, and so I see things in pictures and patterns. Not a very strong math person. Never have been.
Yeah, I have a 6 a.m. Alaska time disorder.
Don't make me laugh this morning. Don't make me laugh this morning. How did you get to Alaska? Were you in the military?
My father was military.
Okay. All right. That explains that. So here we go. I want to show you something here. On this mortgage, all right, the principal and interest payment is $2,568.18. The very first principal payment, are you seeing this? When it stops moving, the very first principal payment is how much, Miss Leslie?
I had paused it. My apologies.
Oh, okay. All right. So are you using the same device?
No, I changed to my laptop, but I paused it because I couldn't hear you.
Oh, you want to turn down the volume on your other device.
Right.
That way it won't bother you. Okay?
Right. Of course.
Yeah, you don't want to pause it because then it'll be way behind.
Yeah, the weird. I know, and I am right now.
Okay. So you probably want to go out or at least if you can fast forward or go out and come back in so it's all caught up. All right. Go out and come back in to YouTube because it's all caught up, and then turn down the volume on your other device.
Okay.
All right. All right, folks. While she's doing that, here's what we're looking at. $234.85 out of all of that money is used to pay down the principal. That's it. That's it. All right. And the amount of interest is $2,333.33. Ms. Leslie, are you seeing that?
Yes, I see it now.
All right, great. Excellent. Now, do you see the next principal payment for month 2?
Yes.
Okay, now let's just say you make your mortgage payment in January and your client says, you know what, this 8%, that's gonna hurt me. I can make the payment. I can afford the payment. I just don't want to afford the payment. Now, this is not for people who can't afford the payment now. It's for people who can. They just look at 8% and get scared. Okay, Miss Leslie?
Of course.
All right. So now, so let's make our first payment in January, and our February principal payment would be how much money?
First payment, 236.41.
Exactly. Now, if we make a payment in January, do we have to wait till February to give the bank $236.41?
Obviously not.
Okay, we could give it to them in January if we had it, correct?
Right.
All of that money goes to principal, and we're paid down to line 2 immediately in January. So that means our next mortgage payment for February is on what line of this schedule?
It's on for February. It's on line 3.
Exactly. The payment for March actually moves up one. What just happened?
Okay.
For $236, you got rid of line 2 on your amortization schedule. One whole line is gone. You just turned 360 monthly payments instantly into only 359 monthly payments by choosing when you give the bank this $236.41. And here's my next question to you. The interest on line 2, the $2,331.77, what happened to that?
The interest, it went down.
And it went down to what?
Minus the 236.41.
Okay. That's what most people believe, Miss Leslie. But what really happened, it went down to zero. This is money you never have to pay.
Oh, wow. So you saved all that.
You saved all that money. So the bank wants on this loan $574,544.80 in interest. And you just cut that down by $2,300 by giving the bank $236 ahead of time. How about that?
Wow.
Okay.
Beautiful.
Let me ask you another question. Okay. We make our mortgage payment in January, and this particular client does have a few bucks in the bank. Let's say they decided they wanted to give the bank the principal payment of $236.41 from line 2, $237 from line 3, and $239 from line 4. Okay. A little over $700. Okay. Applied to the mortgage. What would happen to these 3 interest payments on 2, 3, and 4?
What would happen to them? You're paying them, right? So
no,
Bye-bye.
no, they're gone.
they go away. Okay.
You just saved $7,000 in interest you never have to pay.
Wow.
Isn't that something?
That was one thing, because I like to pay lump sum payments.
Yes.
And that was so you have to call the bank and let them know, because I pay online as well.
Right.
But you have to call the bank and let them know that this needs to be directed specifically toward your principal payment.
That's if you escrow.
Okay.
Yeah, if you escrow, then most banks, their default is to put that extra money in that lump sum payment in your escrow account. All it takes is a phone call to transfer it out, though.
Okay.
All right. But that's more time than you want to spend. Or if you pay it online, your bank may have a line set aside for principal payments only. And that will notify them as well. This is where to put that money. Okay.
Okay.
All right. So now you said lump sum payments. Can we do a lump sum payment today?
Obviously.
All right, on my screen, watch this. I need you to take a look at cumulative principal and cumulative interest. Here's why I use Brett Whistle, B-R-E-T, Brett Whistle. Let me put that in the chat right now so people can use this to play around with, okay? So we're going to put that in the chat so people can do that. All right, paste. Somebody else wants to come to the stage. All right. Let me bring you up as well. There we go. All right. Papa, bring you up as well. All right, ma'am. So here's what we're saying. The reason why I use Brett Whistle is because we have cumulative principal and cumulative interest here. Most people are totally unaware of how much interest they're consuming in 1 year. or how it looks. So if we take a look at line 12, cumulative principal and cumulative interest, we pay this loan down in 1 year by $2,923, don't we?
Oh, wow.
Okay, that's it. That's all that goes to principal. How much goes to interest?
What, 252.65?
Oh, no. Line 12. Look at
Okay.
look at column 4, cumulative interest.
Okay, I see where you are.
Yeah.
So
How-
27,894.
Are you kidding me? $27,000 in 1 year just going to
1
interest?
year. Wow.
Because here's what's
And I
happening.
owe.
Here's what's happening.
Okay.
If we work this thing according to the bank's timing,
Mhm.
every month we give them 234, 236, 237, all right? And the interest payment is 2,333, 2,331, 2,330. All these 2,300 payments all month, all year long add up to $27,894.34, where all these $230 payments add up to $29,2382. So, Ms. Leslie, how fair is that?
That's beautiful. And it's so sad at the same time.
Okay. So you said you like lump sum payments. So what if I
Mhm.
did this, pointed this out to you? I know that because of adding this up, I will eventually give the bank $2,923.82 that goes to principal, right?
Mhm.
Do I have to give that to them in 12 monthly installments?
That's what I always thought.
Ah, but what if I had it, could I give it to them on line 1?
Okay.
All right. If I had it, can I do a little bit of math? Remember, our original loan is $350,000. Okay. We start
Mhm.
out at, we start out at 350,000, right?
Mhm.
And if I give them the 2923.82 all at once, they have to subtract that from what I owe, don't they?
Okay.
Okay. So let's subtract that. 29, 23, and 82 cents equals $347,076.18. Isn't that the same thing that's on line 12 here in principal balance?
It is.
So are you telling me if I give them that money on line 1, I'm paid all the way down to here in just 1 month?
Okay.
What happens to all the
But
interest
yeah,
between
that's what I
line
need
2
to
and
know.
line 12?
What happens to it?
You never have to pay it. So here's what we're saying. You could do it the bank's way and give them
Mhm.
$27,894.34 in interest to pay down to here. Or you can pay down to the same place by giving them the 2932 up front and only pay $2,333. So which would you rather pay to pay down to here? $2,300 or $27,800?
Of course, the 2000.
There you go. That's how it works.
Mhm. Wow.
All right, now let's just
I
say,
have a question, sir.
all right, who has a question?
I'm sorry, Chairman.
Go ahead.
Okay, my question is, I tried to do that because I listened to it somewhere else, and when I do it, my bank doesn't apply. They wait for me until I pay the monthly fee. When I asked them, they said that's how they work. So
Well,
I
and they're right. You have to make your regular mortgage payment first.
I
Once you
did. I
once you
put
make your regular mortgage payment, then any money you add goes to principal. If you tell them,
okay. So if I make my mortgage on the first,
yeah.
and the person I listened to said to pay it on the 15th. So on the 15th, I had extra 500. They don't apply that 500 until the next month when I make my payment. I
All
don't
right.
know why.
Tell me, tell me how you're giving that to them. Explain it to me how you do that.
I push it online. I say extra payment
Okay.
because I
Now,
select it online. I don't go.
If you do it online, are you putting it where the mortgage payment goes? Are you putting it where it says principal only payment?
They don't have that option. They just said extra payment.
All right, then
So I
if you do that, then you are going, if they don't have a way to do a principal only payment, then you are going to have to contact them and ask them, I want to send you a principal only payment. How do I do that? And they'll give you the instructions. Okay?
okay. Thank you. Okay, thank you.
You're so welcome.
I
Yes, Dwayne.
Yeah, I can't get on the other computer, so I'm using it on one. But so it seems just it seems reasonable to me that most banks would not just set it up that way. They're not going to reveal where they make their real money. And so you're saying, as a matter of theory, this is what should happen.
Oh no, it's
And
not. It's not a matter of theory. I've been doing this
yeah,
for 18 years, and I have clients that have paid off several
yeah. What I
houses.
mean is, yes, sir. What I mean is that when we ask the banks to do that, they're not set up for us to tell it. But when we ask them to do it principal only, they have to do it as a matter of law. That's my question I'm asking.
As a matter of law, it's in your
Absolutely.
it's in your contract.
Absolutely. Thank you, sir.
It is in your contract. In fact, if you go to your mortgage note page, there's something that will read something like this. You have the right to make principal payments before they are due.
Mm-hmm, mm-hmm.
It is there in your contract in writing.
In the fine print. Yes, sir.
Yes, sir. Yes, sir. All right. And that's what we're talking about today. And you want to know, not only do you want to know that you can do it, you want to know what you're getting for those prepayments so you can save that money. So what good is giving the bank money? Because they will not tell you how much you saved in interest, will they?
Nope.
Nope. What good is doing it if you have no idea how much you're saving? And this is why more people don't do it, because they have no idea how the whole system is set up and how they can make it benefit them. All right.
Right. I I have a question to ask.
Yes, sir. What is your name?
Anguilla.
Okay, Anguilla, go ahead.
Yes. First of all, thank you so much for this information. It's actually very enlightening. My question is, and I know it kind of we're on the mortgage track, but another massive amount of debt that people carry is the student loans.
Right.
I'm wondering, does this also cross over into like the student loan to
Most
kind of pay
definitely.
down the principal?
Most definitely. Dwayne, will you go ahead and mute your mic, please?
Yeah.
All right. So Anguilla, let me put another. I had a student not too long ago give me this. And I'm putting on the screen now, okay, a student loan, all right, of $9,000, okay, $500. That's all he had. Believe it or not, he was able to graduate with a student loan of $9,500, and he had a payment that was income based, that was $50 a month. His interest rate was 6%. So, how many years do you all think it would take to pay off $9,500 at 6%, $50 a month? If you were just guessing. Don't do the math, just guess. Give me a number.
20 years.
20 years. Anybody else?
Say 10.
10. Okay. Let me do the numbers for you. 601 payments. That's 50 years. 50 years, ladies and gentlemen.
Wow.
Okay. Now, I need to show you. Now, based on what you've just learned, now we're talking about student loans here, right? Based on what you've learned so far, I need you to take a look at how much is going, and when it stops moving, because we're on the internet, it takes a little time to transfer where you can see it. How much goes to principal and how much goes to interest? Can anybody see that? How much goes to principal? How much goes to interest?
Yes, I see the first one is
Who's that talking? Okay. How much goes to principal? How much goes to interest?
The first payment it's 250
Two
for
fifty
principal.
principal. And how much goes to interest?
4750.
So out of that $50 payment, this is what, see, listen, if we don't understand what's going on, we will do exactly like this. We'll take that $50 payment, we'll make that $50 payment because it fits in our budget. Okay. Now, based on what we've learned so far, if I make my first payment here, I can look at my second payment and only $2.51 goes to principal. If I pay that early, do you realize I save $47.49 in interest I never have to pay for $2.50? Ladies and gentlemen, this is how this thing works. If you add up all the principal payments for 1 year, it comes to $30.84. Are you seeing that, Anguilla?
Yes, sir.
And how much interest will we pay in 1 year?
Cumulatively $30.
No. Cumulative interest is the fourth column.
$569.
How much?
$569.16.
Exactly. So, Anguilla, can I ask you a question? Would it be possible?
Yes.
Would it be possible if I make my $50 payment in the first month and give the bank an additional $30? Will I knock off 1 year's worth of payments?
Yes.
Will I save this interest?
Yeah. And what's funny is that this is actually it plays because, like, for the most part,
yes,
this is kind of enlightening because it plays on the fact that a lot of people don't really actually know this.
No.
And we keep on giving the bank our money.
Yes.
And they just keep on taking it, and nobody really is out there like educating the masses on how to actually not waste your money to the bank. This is actually very enlightening. It's just it's actually quite mind-boggling if you kind of think about it.
Well, let me show you something that's going to boggle your mind even more. This is just the first year. $63.57 knocks off 2 years off this loan and saves over $1,100 in interest. Oh, wait a minute. $98 knocks off 3 years. Wait a minute. $135 knocks off 4 years. $135 paid at one time knocks off 4 years on this loan. And let's go all the way down. Let's just do 60 months. Do you think I might be able to find $174.42, apply it to principal, knock off 5 years off this loan, and save over $2,800 in interest? What do you guys think? How powerful is that?
That is actually wow.
Isn't that something?
Criminal. It's criminal.
Otherwise, you have to pay the bank. You'd have to pay the bank on this student loan that's $50 a month. You'd have to give them all these $2 and $3 payments each month, and all these $47 payments each month to pay the loan down by $174.42, and look at there, and pay the bank $28.25 in interest in the first 5 years on this student loan. Are you talking about you talk about something that's criminal, right?
Yeah, I am shocked. I'm still shocked, actually. I am shocked.
So listen, that's how we can take care of student loans. Now listen, I'm putting my link at the top. Now, I'm just showing you all the basics here. We have a cloud-based AI computing system. Remember when I said we have the average family has about 13 different loans? You want to be specific in how you attack these loans, and you want to be strategic. We have an AI computing system that takes a look at all of your finances and instructs you, like financial GPS, move this much money in this month on this day of the month and attack this particular loan so we can optimize our interest savings. I'm putting my link at the top of the page. It is ICE, the number 10, the letter K.com, ICE10K.com. And everyone here can get a savings and earnings report. Just click on that link, click the button that says get a savings and earnings report. And if you're watching online, it looks like this. ICE, ICE, come on. There we go. ICE10K.com. And you scroll down past where you see Dr. Eric Thomas. Scroll down past that, and there's the button. Get a savings and earnings report. And when you click that button, here's what it says. Don't waste another dollar paying off the wrong debt. Get your free savings and earnings report. How would you like to know the month, day, and year you could be debt free? Okay. Now, I just wanted to, in case anybody had to leave, I want to get back to Ms. Leslie's question and Dwayne's question about these higher interest rates. Now, let's get back here. All right. I have an 8% interest rate. When I have my 8% interest rate on $350,000, I have a very small principal payment. Are you guys seeing that? Okay. Now, if I take the same loan and buy down the rate to 6%, because that's what they're doing now. They're buying down the rate. They're taking their cash, giving it to the bank, buying down the rate. And now, where I didn't need a lower payment, I just wanted a lower payment. Now my payment is $2,098.43 instead of $2,568.18. Now, at the higher interest rate, look at my principal payments, $234, $236, $237. At the lower interest rate at 6%, look at my principal payments. Oh, $348, $350, $351. You see, when I lower the interest rate to get rid of one line, it takes $350 to get rid of line 2. Where at the higher interest rate, it only takes $236 to get rid of line 2. Remember, Miss Leslie, when I pointed out that cumulative principal and cumulative interest here, $2,900 gets rid of 1 year's worth of payments on this loan at 8%. When I lower the interest rate, if I want to prepay $2,900 on a 6% mortgage, 6%, 30-year mortgage for $350,000, $2,900 only gets rid of about 8 payments instead of 12. It is actually easier to save money and kill a lot of interest at the higher interest rate. I never buy down the rate. If I can afford this payment, and here's another thing I don't tell my clients when they come to me. You know what they're saying? Marry the house and date the rate. When the interest rate drops, when the interest rates drop, refinance into that lower interest rate. And the bank is saying, they're just chomping at the bit. I wish they would refinance to this lower rate because it's going to make it harder for them to pay the loan off faster and cheaper once they lower that rate. Not only that, but guess what I get to do? I get to charge them a whole lot of money that they never even notice when they refinance. Are you all ready to see that? Let's just say they get this mortgage and they follow that advice. Okay. They've got this mortgage, and in 5 years, okay, 60 months, they've paid it down to here. Look what they did in 5 years. They only paid the loan down by $17,255.75. But look how much interest they've given them. 130. This is a person that doesn't know anything about the P.I.L.L method. Okay. They're not using our system. $136,000 in interest they've paid out already. How much do they owe? They owe $332,000. 744.25. The interest rates just dropped by 2 points, and so they had 8. Now everybody's rushing to get refinanced into the 6% mortgage. Is that right, Dwayne? Is that right, Leslie?
That's so true. Everything you're saying is so true. Everybody's buying down the rates.
Yes.
And
Yes, sir.
Okay.
Yes, sir.
All right. So here's what they're doing. Now I've got this, and after 5 years, here's my new loan, 332,000. All right, 332,000. I'm copying this. I'm going to open this up. Okay. We're going to put this new amount into my calculator here because I'm refinancing. All right, so we're going to paste that in. Now, if you do that, if you use this, you got to get rid of the comma because the program doesn't like those commas. All right. Now, I don't have an 8% mortgage now. I have a 6% mortgage, but guess what they'll also do? They'll give me, after 5 years, they'll give me a brand new 30-year mortgage. I need you all to understand this right now. It is not necessarily the interest rate that lowers the payment. It's taking what I owe and dividing it by a new 360 payments. That's the principal thing that lowers the payment, not the interest rate. They're going to get a brand new 30-year mortgage. And if I've already been in this loan for 5 years, guess what? Now it's a 35-year loan. Are you guys with me? Now,
This is how they've been, taking people to the cleaners on, without that knowledge. They're literally just taking you to the cleaners.
Exactly. Now, let's not forget the closing cost. Now, I paid down the loan to $332,744. Okay. And so that means if I do $10,000 in closing costs, which is not outrageous, right, Dwayne? 10,000 in closing costs?
Absolutely not.
All right.
That's correct.
Not outrageous. So that would be 342,000, right? And here's my new payment. $2,054.92. My old payment, was $2,568. So I feel really good about this new payment. Okay. $450 less. Boom. I'm feeling real good about it. But I'm not thinking about the fact that I just got a new 30-year loan. I'm also not thinking about this, ladies and gentlemen. I just rolled $10,000 into this 6% mortgage. But I guarantee you it's not a 6% mortgage. Let me show you what happens to pay, because I have to pay off the first $10,000 to get back to my original $332,000. Is that correct, Dwayne? Is that correct, Leslie? Okay.
Yes, sir.
Okay. So let's pay off the first $10,000 because that is the closing cost I rolled into the loan. In the first year, I need you guys to take a look at column 3, cumulative principal, and column 4, cumulative interest. In the first year, I only pay back $4,208.86 of the $10,000 I rolled into this loan. How much interest have I paid on a $4,000 loan so far? I need you all to tell me.
That's $20,450.
Listen, if your credit union called you up today and said, listen, I got a deal for you. I'm going to lend you $4,200 for a year. And all you got to do is pay me back the $4,200 and $20,000 in interest. What would you tell them?
No, thank you.
That's exactly what's going on here, Miss Leslie. Isn't it? By the time we pay off the first $10,000, it takes 28 months, over 2 years, to pay off the closing costs on this loan, to get back to the original $332,000 I had before I refinanced. And how much interest am I paying on a $10,000 $40,000 loan, ladies and gentlemen. I need y'all to say it.
47,310.
That's crazy.
Isn't it though? This has been going on since 1936, and no one, I mean absolutely no one, has been pointing this out. You won't find this anywhere else on the internet. You won't find this in any other book on Amazon except my book. How come no one is talking about this?
Wow.
Ice, baby. Too cold.
Okay?
Wow.
That's what I'm talking about, ladies and gentlemen. So listen, can I show you one other thing? Can I just talk? Listen, if you borrow $10 from me, all right? Hi, Anna, let's get you on the stage. If you borrow $10 from me, okay? And I say pay me back the $10 and then give me $10 interest on top of that. What interest rate am I asking for?
100%.
100%.
What was the question?
If you borrow $10 from me and I say pay me back the $10 plus $10 interest, what's the interest rate?
Oh, yes, 100%.
Okay. Does it matter if I call it 6%?
Wow.
Okay. Here's what I'm asking you folks. If I borrow $10,000 from the bank and pay back the $10,000 plus $10,000 in interest, isn't that an 100% loan?
Yep.
What if it's 20?
Absolutely.
What if it's $20,000 in interest? What is that?
On 10,000?
Uh-huh.
200%.
What about 30%?
300,000?
This
30,000.
this is $47,000 interest to pay back a $10,000 loan, ladies and gentlemen, and the bank gets to call this a 6% mortgage.
Oh my God.
470% interest legally.
Oh, oh my God. I am so shaken. When I was in school and were doing finance,
Yes.
they basically just told us that, hey, listen, you just have to sit there and get shafted. Like, excuse my language, because the principal payments literally go to paying out the first part of the loan, and it's like they're protecting themselves because the asset is the value of the asset is paid down at the bottom half of the loan. Like when you cross the bottom half of the loan, they get paid. That's when the asset is getting paid down. But on the top half of the loan, they're paying down the interest rate. So they're getting they're getting their money like kind of like upfront, and then as asset depreciates, then that is like on your side. So basically, it's just you to sit there and and just take it.
Well,
Just take it.
Can I really explain to you what's going on? And then I want to get Anna in here, okay? Because she's been doing this a very long time. And thank you for coming in, Anna. Please hang out. All right. So here's what's actually going on with your mortgage, ladies and gentlemen. If you got your mortgage from Chase or Bank of America or Citibank, okay? Well, no matter where you got your mortgage from, they don't keep that mortgage. They sell it to an investor. They buy that mortgage at a premium. And I need to ask you a question, okay? When you make this mortgage payment, when you make your mortgage payment on this loan, and your mortgage payment is a total of $2,054.92, how much of this money, of the payment, does the investor get? How much of the payment does the investor get? $2,054.92. How much?
So they get all of the interest, not the principal, but it depends where you are in the amortization as to how much they're actually getting.
The investor gets the whole payment. They get everything. The only thing that happens is on the back end is a math problem, and $341 of that payment is credited to paying down the principal. But the investor gets the whole doggone payment, the whole thing. And the reason why they love this amortization schedule is because of what's called the rate of change. The rate of change. And because the rate of change, based in the algorithm for amortizing this loan, is so small, 341, 342.90, 344.62, to pay back $350,000, to show that I've paid back $350,000, I have to give them all of these. I have to subtract from what I owe these small payments, which means I have to make another payment to the investor, then another payment to the investor, then another payment to the investor, because the rate of change is so small. They get the whole thing. Isn't that something? If once you start thinking about what's really going on behind the scenes, this whole thing is set up for the investors. It's not for us. The whole thing is for investors.
So, Ice, what do you say to the person, to the family that has been paying a mortgage for, I don't know, 10, 15 years, and clicks on and sees your presentation and says, "Oh man, we got to change this," and they've already perhaps refinanced once or twice, and they've restarted their loan once or twice already over 30 years. What do you say to that person? What's the solution?
The solution is get a savings and earnings report, learn how to pay this mortgage back at 1/3 the cost, and save a ton of interest. And chances are, you can save enough interest to pay yourself back for all the interest you've ever paid in life.
Excellent answer.
Okay.
Excellent answer. You say that again, because I don't think everybody heard that.
All right. So here's what I'm saying. Let's say the total interest cost on this loan, if I do it the bank's way, is $397,000. $397,000. Okay. So I could tell I say, listen, what if we could get you into our program? All right. And you wouldn't have to pay $397,000. Let's just say I can get you to pay $132,000, okay, or less. So let's see, -3, okay. That saves you $264,000 in interest on this loan you would not have to pay. What if I could tell them that, Dwayne?
Huge.
Okay.
Absolutely huge.
There you go. Miss Anna, how are you doing this morning?
I'm doing well. I love that you're, providing this education. And you had asked the question earlier, why do you think people don't know this, or why aren't they sharing it? Well, anything that actually makes sense and is a great way of, if they can't figure out how to monetize it, why the hell would they tell you?
Exactly. Miss Anna, will you tell the folks what you do, please?
Today I do cooking. It's Sunday, but generally speaking. Oh, and my brother bought me this big ass mixer. All I wanted was one of those little KitchenAids that sit on the countertop. And no, he had to go get the Mac Daddy with the wheel away cart. And I don't know what to do with this darn thing. And I'm trying to figure out how to turn it on today. But outside of that, I've been a realtor for the last decade. I'm also an investor mentor. But prior to selling real estate, I managed a HUD housing counseling agency. And prior to that, I was a loan officer.
Wow. Thank you for being here today. So, do you have any questions or comments about what we've gone over so far?
I think really just the comment and why I appreciate these spaces, it is interesting because whenever there's a room about education and true counseling and advice, they tend to be the smaller, quiet, calm rooms, right? But anytime there's some drama, and whatever. It's like a car accident. You just can't look away. And everyone's in there not learning. They're just frying their brains with the nonsense and whatever. So, you know, respectfully commend yourselves for taking the time to be here and get that education that as a realtor, I will say, especially with the recent lawsuits and all the fun stuff going on in the real estate industry, if you can't stand apart and if you can't be that true advisor, consultant for your client, well, you know, you're just an Uber driver with an E key and you'll be out of business before you know it. So, with regards to this program, I love it. Yet, the caveat, I think, and correct me if I'm wrong, if you've gotten yourself into a mortgage that you are barely able to keep up with from the minute that you get it, there won't be any additional funds to put towards re-amortizing the loan. And, you know, the best way, but it's challenging in today's market, is to get into something where you're not house poor, right? That not every penny is going to the home. And I know that's a challenge because house prices are absolutely ridiculous. But would you agree if you come into a mortgage and you are true, you know, you're just strapped and it's difficult to pay that mortgage, well, you wouldn't be able to perform the P.I.L.L method because you don't have the additional funds monthly, quarterly, bi-yearly, whenever, once a year, whenever it is that you're making that additional payment. If you don't have that additional liquidity, you wouldn't be able to perform.
You are so right. And this is what we want to help people listen. You may not be able to get your dream home right away. You may have to work up to it. Okay. But based on that, you never want to put yourself in a position where you're trying to buy a home and you don't even have the money to do the maintenance on the home. That doesn't make sense. So that when you take a look at your budget, your real estate agent, your mortgage professional should be able to talk to you about how much of your budget do you want to go to housing? 28%, 30%, 35%. When it starts getting more than 35%, you're hurting yourself if you get that high in your budget to pay for a house. So find that out ahead of time, folks. Leave yourself some cash, leave yourself some room to work with it. But let me show you one other thing, okay? Let me show you one other thing because it doesn't take a lot of money to save interest, but I'm going to need somebody to help me with this, with a calculator. Okay, who can help me? Dwayne, can you help me? All right. Anna?
I got a calculator. Go ahead.
Okay, Anna, you got a calculator. Okay, here's what we're going to do. I'm going to go back to my original 8% mortgage here because that's what's strapping people. And if I prepay $236.41, I can save $2,331.77. So Miss Anna, I need you to put into your calculator $2,300, 2,331.77. 2,331.77. That's what I need you to put in your calculator. And in my calculator, I'm going to put in 236, $236.41. So now I don't have to prepay, Miss Anna. I don't have $236.41. I have half that. I only have half. So I'm going to divide mine by 2, and I need you to do the same thing. Divide yours by 2. I have $118. How much interest can I save now? What's your calculator say?
Oh, I couldn't get switched. 1165 and 89 cents. 1,165 and 89 cents.
That's still worth it, isn't it?
Sure.
Okay. Well, I don't have 118. I have half of that. So I'm dividing mine by 2 again. I've got $59. Okay. Tell me how much interest I can save with $59 now.
582.
Ooh, still pretty good. I don't have $59. I have half of that. Divided by 2. I got $29.55. How much interest can I save now?
$291.
See, you don't need a lot of money to save a ton of interest, ladies and gentlemen. Let's work with what you have until we can do better. And guess what and this is what I've been told over the years. I believe it to be true. In most cases, the mortgage gets easier to pay the longer you're in it. Why do people say that? The longer you're in the mortgage, the easier it becomes to pay. Why do people say that, Miss Anna?
Well, I mean, you would assume that income would go up, right? And so if the payment's staying the same, you should have more money monthly to be able to put towards the payment.
Exactly. So wherever
instead,
yes. With that being said,
what's the stat on how long does the average mortgage last? I think it's 7 years. Wait, that's how often people move. It might be less than that. Someone's going to have to Google it. But even though we all, obtain these 30-year mortgages, on average, though, homeowners don't stay in that original mortgage. So instead, they refi and get that new payment based on that new income and start it all over again.
Exactly. So, ladies and gentlemen, if that is the case, that's why we don't have 30-year mortgages in the United States. We have a string of 5 to 7 year mortgages until we die. 9 out of 10 people will never pay off a mortgage. I got Tico Blaine here who's watching us online on YouTube. He says, I want to be the bank. All right, let me put that on the screen here. I want to be the bank, he says. All right, I have a house for sale. After watching this, I think I need to be the bank versus the consumer. In other words, Tico, you want to say, listen, I will self-finance this thing at this kind of interest. Do you know more and more people are actually doing that? More and more people are actually doing that. And when you do that, you get the whole payment. You get the whole payment, Tico. And when you do that and run it through an amortization schedule, because of the rate of change, that will determine how many payments you will actually receive. You will receive 360 payments. Or if somebody increases the rate of change, this is what we're doing with the P.I.L.L method. We're showing you how to easily increase the rate of change with even a small amount of money that you may have, all right, to work with. Increase the rate of change, and then you'll make fewer payments to the investor. Does that make sense, everybody? Okay. You control the rate of change. You control how much money goes to principal. You can control when you pay your bank or investor. You control that. When you're in control, you pay a lot less interest, more of your money goes to principal, and you save a ton of money and you get out of debt faster. It's just math. I'm just loving this. So, anybody else got any other questions or comments? Miss Leslie, did you? Go ahead, Anna.
No, Leslie, please go ahead.
Hey, Miss Leslie, I remember you saying something about helping your clients to understand. Did you see what we did with that 8% mortgage versus the 6% mortgage?
Yes, I saw that. Yeah, I feel so bad now because I've encouraged people for so many years, especially our community, to purchase homes and really not understanding this part of it. They got in at good rates so far, but now I want to be able to go back and explain. I think I'm definitely going to share the video on the YouTube channel, but I want to be able to. So I'm going to study it myself.
Yes.
So I want to be able to answer those questions for them.
So, Leslie, can I ask you a question?
Sure.
Were you giving the very best advice that you knew how at the time?
Yes, for sure.
Then there's nothing wrong with that at all. At all. When we know better, we just do better.
Exactly.
Okay. Listen,
Mm.
I'm telling you, there's very few places you're going to get this, and even now, even on Clubhouse, amongst people who have been investors for a very long time, push back against this information. Okay, because they're saying, Don, why do I need to take any money to pay off a 6% mortgage or an even 8% mortgage when I can take my money and invest it and make 20%? If I'm really good, I can make 25% cash on cash return with my money. Why would I do this? Why would I pay down a mortgage when I can make that kind of money? I get that all the time. All right. And I want to handle that right now for anybody who's a real estate investor that has heard that. Okay. Right now, I want every real estate investor to know whatever percentage of your rents that you're getting in that you're reinvesting right away, I need you to continue. Yeah, I'm not changing that. I don't need to change that. Continue to invest what you are investing. Okay? So now let's get that out of the way. Don is not telling you not to invest. Go ahead and keep on investing as you're investing. Listen, you're doing a wonderful job. Obviously, you're still in business. Okay? But every real estate investor that's worth their salt that I've talked to puts money aside for repairs and maintenance. And it's sitting in the bank, making 0.1%, waiting for something to go wrong. It's just sitting there. So if I've got some money sitting in an account making 0.1%, whether it's $5,000, $10,000, maybe $25,000 I have sitting in the bank, depending on how many houses I have, how many buildings, that we're operating. I've got 25 grand in the bank. Do you think that I can take some money out of the bank that's making 0.1%? And in this case, I can take $236 out of my bank that's making 0.1% and invest that in prepaying this mortgage and save myself $2,331.77. If you are in business, ladies and gentlemen, do you know there's more than one way to increase profits? Yeah. What if you're in the restaurant business and your advisor came along and showed you how to reduce your food costs by 23%? Reduce your food costs by 23%. Does that increase your profits? Yes or no, everybody?
Yep.
Okay. Now, I didn't sell another meal. I didn't have any more customers. I didn't do anything. Listen, I didn't raise my prices. I just reduced my expenses, which increases profits. How about that? So I have this money on the side. And if I can reduce my expenses, do you know I can count that as a return on investment? Whatever I paid the advisor, and I increase my profits, I can now look and say, okay, what did I invest and what did I get out of it? I can invest and then look at my profits. So in this case, I can take money out of my bank, prepay this mortgage, and if you look at YouTube will tell you how to figure ROI. Take what you invest, and then your result for investing, take your increase and divide it by what you are investing, and then multiply that by 100. Let me do the math for you. I'm putting it on the screen. If I do this, I'm going to save myself. If I prepay the $236.41, I'm going to save $2,331.77 in interest I never have to pay the bank. What did I have to invest to get that? $236 out of my reserve fund. Okay, I'm going to take two. So I divide that by $236.41 and multiply the answer by 100. Multiply by 100, and I get 986% return on my money. I dare any real estate investor to tell me how I can make 986% return on my money on $236. Why wouldn't I do that? And continue to invest where I'm investing. Keep growing my portfolio. But listen, folks, it is absolutely ridiculous to keep borrowing money from the bank and give them all of this interest when the amortization schedule is set up for me to win, not lose. It's set up for me to win if I know how to read this thing. Listen, have you ever seen that before where I can take 236, make 2,331, do the math, and it comes out as 986% return on my money? Have you ever heard of anybody else doing anything this is guaranteed return on your money? It's not like the stock market where there's risk. There is no risk. I prepay. And they said, well, Don, there is a risk because you're getting this equity here. And if there's a downturn in the economy, yeah, if there's a downturn in the economy, then I'll be out of business. Either way I go, I'm going to be out of business. To tell you the truth, if I know what I'm doing, most of the time I will not be out of business. So if I'm not going to be out of business most of the time, I want to be in business and put myself in a better position, not a worse position, and not tell myself I'm not going to save 75% of these interest payments only because I'm afraid of a downturn in the economy and losing my business. That's crazy. That's crazy talk. Crazy talk. That's all I'm saying. And what happens, ladies and gentlemen, for a real estate investor, if they're able to gain this equity at a much lower interest cost, is a real estate investor really interested in paying off this loan? You tell me. Is a real estate investor interested in paying off this loan?
Yes and no. Primarily no.
Primarily
Right?
no. And why?
Well, it's just about cash flow. It doesn't really matter what the interest rate or what the payment is.
Mhm.
If based on what my payment is versus what I'm getting, if there's positive cash flow, whatever, like what do I care? And then of course there's the tax benefit to having that mortgage in the first place. So again, I don't necessarily want a whole bunch of properties that don't have mortgages on them. I guess the only incentive to pay it off is to inevitably borrow more against it at some point to go buy more properties.
There you go. There you go. Listen, if I could get that equity faster and cheaper, I can refinance this thing, not to pay off debt. I refinance to make more money. Okay? Listen, if I take $2,900 out of my reserve fund, knock off a year on this thing, and now I've got this much equity, but I didn't pay $27,000 for it. I only paid $2,333 for it. Okay. Now what if I need to build up my reserve fund again? Okay. Let's say it takes me 3 or 4 months to build up my reserve fund again, and I could do another $3,000, wait 3 or 4 months and do another $3,000. And every time I do that, I'm knocking off a year. Okay. Oh my goodness. Listen, I'm knocking off a year on this thing, $3,000, $3,500 or whatever. And every time I do that, every 3 or 4 months, I am not draining my reserve fund. I'm just leveraging it, knocking off a year at a time. I'm getting equity 10 to 15 years sooner where I can refinance, take that money out, and reinvest it in other doors. Ladies and gentlemen, there is absolutely everything to gain by understanding interest cancellation and how much interest we're consuming, whether we are real estate investors or we're residential home buyers. Either way, you're going to make out okay if you have a balance between investing and interest cancellation. Because I can't think of one good reason. I can't think of what, maybe somebody could help me. And I'm going to ask this question and I'm almost done here today. I can't think of one good reason that in just, let's do two years. I can't think of one good reason on this mortgage, no matter how much I'm making, how much I'm cash flowing, to pay this mortgage down by $6,000 and pay the bank $55,500 for the privilege. Can anybody tell me where the benefit lies in paying this mortgage down by $6,000 and giving the bank $55,000 in interest for the privilege? Is there any benefit in that at all? That's what we're talking about. That right there is what we're talking about. Well, if there's tax benefits in the interest that I'm paying, guess what? We're not skipping months. Every month you've got a mortgage payment. Every single month you have a mortgage payment. And every single month you're going to pay interest to the bank. I'm just saying we're going to pay a lot less. So we're not going to give them 360 payments. Because we're advancing the rate of change, we could get to the point where we are going to give them maybe 50 or 60 total payments because of the fact that we are prepaying. Even if we go to 70 to 90 payments, that's still better than 360. And then I can refinance and do the whole thing again. So what's the benefit? I got all of that equity for 1/3 the cost. All I'm saying here, ladies and gentlemen, and we're going to shut it down if I don't have any more questions. If you're a real estate investor, you need to start looking at counting your interest savings as part of the metrics so that you can properly compute how much money you're actually making. Your profits, you need to consider interest cost in that. Because if I was in a room full of 100 real estate investors, and I said, you bought a property for $200,000, and a few years later, you sold it for $500,000, I would then ask, how much money did you make? Bought it for 200, sold it for 500. Every real estate investor in that room would tell me they made how much money, ladies and gentlemen. How much would it?
They would tell you 300, but they certainly did.
They most certainly did not, because not one will consider how much interest they paid to get there. Not one. And it's about time we started adding in this metric to everything else we're doing. We can figure cap rate. We can figure this rate. We can figure everything else, but we don't figure interest consumption. We need to start. Ladies and gentlemen, I want to thank you for joining me today. Do I have any other questions or comments before we go?
I did have one real quick because Leslie spoke earlier, and I'm guessing, Leslie, you're a realtor. Is that right?
Yes.
Okay. and you felt some kind of way because you're like, I'm really trying to do right by people and I'm giving them this information, and now I feel bad. Well, do you have a mortgage yourself? Do you
I
own a
do.
home?
I do.
Great. My advice to you is to get with the pill method first, right? As a realtor, I think that the most valuable piece, part of me or whatever, um, to my clients is my referrals, my references, and my recommendations. But to truly be one who comes from service and refers not for personal gain, but because that person did right by you. You learned something, now you pay it forward and you teach it to others. So apply the method to your own mortgage, recognize what just transpired, and then go and tell, right? Then go reach out to every past client and explain to them what you have now learned and to better, their situation. I mean, people, I jokingly say, my neighbors must think I'm running a brothel because I got every truck, every different, right? Seriously. Now, my husband, God bless his soul, has never so much as hung a picture frame in this house. We call him the demolition man. If you want something to be broken down, he could do that, but he cannot fix a damn thing, which is funny because I come from a whole family of contractors. But nonetheless, my point is, I don't send a painter or a plumber or anyone in between to my clients if they haven't painted something in my home, fixed something in my, I want to know them. I want to see how they perform, their response time, their cost, all the things, so I can then refer them to my clients. I suggest to you to do the same. Be the client first, see the process through, understand it at the core, and then go share it with others. There's no shame at all in not knowing what you didn't know. The shame is not being willing to learn and provide that service going forward.
I agree. Thank you so much, Anna. I'm definitely gonna do that.
All right, everybody. Let's listen. Let's follow each other as friends, and then reach out. Let's make some connections here, right here in the mortgage syndicate. Where the mortgage syndicate is actually they're here most of the time, Monday through Friday. I come in and share this space with them on Sundays for about an hour and a half to 2 hours. And I'm the I have the Pill Method House, and we do two rooms, Wednesday and Friday in the Pill Method House, and on Sunday we're here in the Mortgage Syndicate. And I'm also live each time we go live. I'm also live on YouTube, Facebook, Twitter, and LinkedIn, so people can see the numbers. Okay, folks. Any other questions or comments before we get out? All righty then. Okay, so here's what we're going to do. I'm going to share with you, everybody. Mr. Dwayne, are you raising your hand, or you just waving?
I'm saying thank you, and I'm clapping. Thank you so much.
You are so.
Thank you so much. I left my number in the chat as well, so I'd like to connect.
Oh, okay. Listen, do me a favor. Put it in my DM and Instagram. Would you please? If you would do that, that would be great, because once we close this down, I don't want to miss.
Okay.
I don't want to
Gotcha.
lose this. Okay. So if you put in my DM on my Instagram, I will certainly get it and we can talk. All right, ladies and gentlemen. So what we're going to do next is we're going to tell you how you can.
I have a question real quick.
Sure, Anguilla. The only reason why I'm shutting it down because there were no questions.
Oh yes. My question is, do you offer mentorship?
Most definitely.
Okay. And how would we get enrolled for that?
Okay. Now, do you have a mortgage? Do you actually have debt?
Yes, I do.
Okay, then if that's what you're looking for, our program is a lifetime program with customer service and coaching. So that is the mentorship that we provide, because the education doesn't just end here. When you become a client, it's a lifetime of education. All right. and technology. So go to ice10k.com, that link above your head. And I'm also going to put it on the screen here. Oops, I should have had my banners going across the screen. So let me put that on the screen too. All right, there it is. Go to ice10k.com and get a savings and earnings report. Let me put that on the screen. All right, get a savings and earnings report. We're going to go back to ice10k.com. Here's what you see when you go there. All right, the first thing you see is Dr. Eric Thomas. Scroll down to underneath his picture, click the button that says get a savings and earnings report. And it says, don't waste another dollar paying off the wrong debt. Get a free savings report. The report is free. The service is not free. You want to know what you're getting up front, totally explained to you. And we have the only lifetime money back guarantee on our service that you'll find on the internet or on Clubhouse. Okay? 100% money back guarantee for life. This program must always work. There you go. All right. And then fill this out. It's 2 steps. 2 steps. Get your and then get a savings and earnings report and find out the month, day, and year you can be debt free and how much interest you can save. The next thing is you may like what you've heard today and, like Leslie, want to share it with others. We have we do some training that we send out to our affiliates. We send them out periodic emails to our affiliates to let them know that we're doing some training. And we've got another one coming up fairly soon. But go to ice10k.com, look at the bottom of the page, and click on Become an Affiliate. It's free. Fill out your name, put in your phone number, put in your email, and then just tell us how you want to get paid and click Submit. It is that easy to become an affiliate. You will not get anything right away. What you will get is we send out periodic emails to all the affiliates to let them know what's coming next. So all the affiliates will be getting some emails. We got one going out next Wednesday. So go ahead and sign up. Also, on the same card, okay, at the bottom of the page, on the other side of the 10K, click on Buy My Book. So when you get the book, ladies and gentlemen, it'll take you straight to Amazon. And if we scroll down today, let me see how our book is doing today on Amazon. Okay, we have, let's see here. There's 33 million titles on Amazon. And let me see, I'm scrolling down. Oh, it's dropped to number 49. So listen, you guys got to buy some books. So I'm all the way down to number 49. So let's do something to move that back up to number 1. We've been number 1 at least 6 different times. Okay. And that's it. So get your savings and earnings report, get the book, and become an affiliate of the P.I.L.L method. That way you will be able to, work with us and know more about what we're doing. The last thing we're going to do here is hear from Dr. Eric Thomas, E.T. the hip hop preacher. He's the #1 motivational speaker in the entire world. And he has said he's used the P.I.L.L method to pay off his own mortgage. And we're going to hear from him in just a second. But I just want you to know, thank you so very much for being. I forgot. I'm doing a special series Thursday nights for an online church. Can I put that banner up as well? Let me go ahead and do that. Let me put that up. All right. And for the online church, the name of it is Living Manna Online Church. And Thursdays, we've already done 4 installments. We have 4 more installments to go. We're at Thursdays at 7:30 Central, 8:30 Eastern, 6:30 p.m. Mountain, and 5:30 p.m. Central. And the title of the seminar is Money Answers All Things, Bridging Faith and Finance Through Stewardship. I believe you're going to be blessed by this seminar. And guess what? They keep all of them up on their YouTube channel. So go to Living Manna Church, okay, Living Manna Church, their YouTube channel, and subscribe, or follow them on Facebook, Living Manna Church, online church, on YouTube and Facebook. All right. Thank you, everybody. Courtney Trent says thank you. I got some stuff from Horace. Thank you very much for being here, Horace, watching us online. A. Smith, thank you for your participation online. All right, everybody. Let's hear from Dr. Eric Thomas, and then we'll say goodbye. I'll come back and say goodbye after that. And let me see here. Where is his video? It's right here. Come on, Dr. Eric Thomas, talk to us.
Listen to me, y'all. But one of his mentees took us through one of their programs, and I paid off my mortgage. But guess what happened? My marriage went to a whole nother level. And you know why? Because my wife is a security freak. And even when I blew up, my wife would be like, oh, you blew up, but how long is you gonna keep making this kind of money? I was like, I don't know, forever. She's like, you sure? Because I'm gonna keep my license as a nurse just in case you don't. So when I paid the house off, my boy was like, you ain't gotta do that, you can do this. But when I paid the house off using that program, it took the stress level all the way down for my wife because we no longer had a mortgage. Does that make sense? That thing that was coming every month, that was getting on her nerves, we didn't have that no more. And so she was at rest.